August has not been friendly to the stock market. In just the last 24 hours, we saw the Dow Jones fall by more than 1,000 points. We saw Bitcoin prices crash. We saw major stock brokerages like Charles Schwab freeze. And we saw the Japanese stock market see its biggest one-day drop since the Black Monday crash of 1987. Obviously, all these things together created a lot of panic and fear for investors and Wall Street, so the Federal Reserve Bank wanted to calm the emotions of the people and the investors. So what did they do? The Federal Reserve Bank president, Austin Goolsbee, gave a talk on CNBC, and what he said was, quote, "If conditions start to deteriorate, the Fed will fix it." What does that mean? Well, we're going to be talking about that in this video. So what I want to do in this video is go over three things. Number one is I'm going to go over why markets have been in free fall this August. Number two is I want to go over this concept of the Federal Reserve Bank fixing it. What does that look like? And the most important thing is I want to talk about you. How do you build wealth? How do you not lose money? And how do you find opportunity? Because I've been seeing a lot of people panic. I don't want you to be one of the people that are panicking. So let's start by taking a deep breath. And now let's understand what's really going on. And a quick reminder that on August 14th and 15th this year, I'm hosting my biggest investment workshop of the year. It is a free and live investment summit where I'm going to be going over how our money has changed over the last 5 years and over the last 5 decades. But even more importantly, I'm going to go over how you can find investment opportunities in this changing economy during a time where inflation is still high, where interest rates are still high, where the economy is starting to slow, and where we're seeing craziness in the economy. Because yes, there are some great investment opportunities. You just have to know where to look and how to identify the financial trends. I'm going to be going over all of these things in my free workshop. So if you'd like to join, all you have to do is register, because we have a limited number of people that can join me live. And I got the link for you down in the description below if you'd like to join me. So let's start by talking about why markets have been in free fall. And the stock market downfall really started last Thursday. And the thing that triggered this initial stock market downfall was we got a new piece of manufacturing data in the United States, which said the manufacturing in the United States has fallen for 4 straight months. And a lot of investors took that as a sign that our economy might be shrinking, meaning entering a potential recession, which created some more worries, which then led to some investors pulling their money out of the stock market and putting it into bonds, which are traditionally safer, which then caused stock prices to fall. Then came Friday. And Friday, of course, it was the hangover of Thursday, but then we got some more bad economic news, because on Friday we got the news that unemployment numbers jumped up. Friday, we found out that unemployment jumped from 4.1% to 4.3%. Now, historically, 4.3% unemployment is still very low. But the reason why a lot of people got worried when we saw this number was because it showed us that, number one, employers are hiring less people than what was expected. Number two, employers are laying off more people than what was expected. And number three, wage growth is slowing faster than expected. So that created more worries about the job market and the economy, which then led to more fears about a potential recession, which then led to more sell-offs. Then things started to calm down a little bit on the weekend until the Japanese stock market opened, and then we saw the Japanese stock market see its biggest one-day drop since 1987, since Black Monday. That then created a whole new wave of fear. The Asian stock market started to go down, and then our stock market opened, and people were worried about what was going on over there, about a potential global recession, about the impacts of inflation, about the impacts of the higher interest rates, about why didn't the Federal Reserve Bank start cutting interest rates yet. There was all these fears going around, so people started to panic. The stock market does not like uncertainty, so that created more of the sell-off, and that's why we saw the Dow Jones fall by more than 1,000 points today. Now, traditionally, and by traditionally I mean before last week, after the pandemic, every time we got bad economic news, the stock market generally rose. Now, you might say, well, why is that the case? The reason why is because many people assumed that if we got bad news, meaning higher unemployment, slower economy, that would mean that the Federal Reserve Bank would start stimulating. They would start printing money. They would start cutting interest rates. This is what Wall Street took in 2022 and in 2023 and in the first half of 2024, every time we got a piece of bad news. Because they were hoping, okay, a little bit of bad news, no problem. Let the Federal Reserve Bank print more money and inflate the stock market. But now Wall Street is looking at bad news very differently than just 1 week ago. Now what Wall Street is saying, oh, this bad news might be a little bit worse than what we would have thought. And maybe these interest rate cuts or money printing might not save the economy as fast as we thought, which is why it's got more people worried. Now, again, I want you to understand what this means for you when I get into part number 3. So this brings me to part number 2. What does the Federal Reserve Bank mean when they say fix it? So let me start by answering that question and then talk about the broader question, because while history doesn't exactly repeat itself, it does rhyme. So when the Federal Reserve Bank today says that if market conditions deteriorate, we will fix it, what does that mean? Well, maybe what that means is they will have an emergency meeting like they did in the 2020 pandemic, and they will announce that they want to cut interest rates sooner than expected. What does that mean? Right now, it's expected that the Federal Reserve Bank will cut interest rates in September, starting in September. Well, if markets continue to go down, the Federal Reserve Bank might start inflating the markets. They might start stimulating the economy by cutting interest rates sooner. Now, let's back up a little bit. The Federal Reserve Bank is talking about fixing it. And I try to keep my opinions out of this, but sometimes they kind of slip out, like they're going to do here. And the reason why is because during this talk that the Federal Reserve Bank president gave, one of the things that he was talking about was his concerns now because he's seeing slower conditions in the economy. More particularly, he was talking about how consumer defaults are rising. And what that means is he is seeing now, the Federal Reserve Bank president has now observed that regular people, regular Americans are maxing out their credit cards and they can't keep making their car payments. They can't keep making their credit card payments, which has them a little bit more worried about the economy, which is a little bit strange because this really isn't news. I mean, we've been talking about this for a long time on Market Briefs. We've been talking about this for a long time on my channel. Pretty much everybody has been talking about this. And the Federal Reserve Bank now is saying, well, if we see the stock market fall, we'll come in and fix it. But if the Federal Reserve Bank comes in and quote unquote fixes it by cutting interest rates, by printing more money, what would that do? Well, to answer that question, let's go back a little bit and let's talk about what happened after the 2020 pandemic when the economy was in free fall. The Federal Reserve Bank quote unquote fixed it, right? Because they opened up the money printer, they started quantitative easing, meaning they started printing money, they started giving this money to the government, they started injecting this money into the markets, they started buying corporate bonds, they started buying treasuries, so they injected this money into the markets and they fixed it. Markets started to rally. We went from seeing the fastest stock market drop since the Great Depression to the fastest stock market rally in the history of time. All of that happened within a span of 6 months in 2020. So they fixed it, but then there was a consequence, if we all remember. The consequence was transitory inflation. Transitory inflation started in 2021. What was the cause of transitory inflation? Well, a lot of people point different fingers at different things, but the real cause of the transitory inflation was the money printing, because the money printing then devalued the value of each individual dollar. So you print more money, you give it to people. You give it to people in the form of stimulus checks, unemployment checks. You give it to businesses in the form of PPP loans. You give it to corporations in the form of bailouts. You give it to the government with a blank check. Now, everybody has a whole lot of money. Everybody has the ability to spend, but the value of the dollar starts to drop. And then the consequence is the prices of things start to go up. So we started to see car prices rise. We started to see home prices rise. We started to see grocery prices rise. We started to see flight prices rise. We started to see hotel prices rise. I mean, the price of everything started to go up. And then we were told that this was a transitory issue. Remember, the Federal Reserve Bank was the one that said that this was a transitory issue. Inflation's not going to be around that long. It's just a little bit of a thing that we have to deal with for a few months. Turns out it wasn't transitory. That inflation was a real problem, and it was a lot worse than what most people thought. Well, that inflation problem continued 2021, 2022, 2023, and it's still around. Remember, the Federal Reserve Bank used to say, before a couple months ago, they used to say that they're not going to start cutting interest rates until they see 2% inflation. Now remember, when the Federal Reserve Bank talks about inflation coming down, that does not mean that the prices of things are going to fall. When the Federal Reserve Bank says that they want inflation to be 2%, that doesn't mean that the prices of things are going to fall. That means that the prices of things are still growing, just not as fast as they were before, which might have you wondering, why does the Federal Reserve Bank want 2% inflation? Why not 0% inflation? Actually, why doesn't the Federal Reserve Bank ask for negative 5% inflation to correct for the huge price growth that we saw last year and the year before? That way regular people have the ability to go out and spend money again. Well, that's called deflation. When the prices of things fall, that's called deflation, and it is a nightmare for central banks and the government. Now you might say, well, why? Deflation is good for people, it is bad for the central bank, and it's bad for the government. And the reason why is because the United States government is the biggest borrower of dollars. They are the biggest borrower from the Federal Reserve Bank. And so right now, the United States government has around $35 trillion worth of debt that they have to pay back. Now, if you have deflation, what that means is the value of your dollar goes up. That means the $100 you have in your pocket can buy you more stuff. But deflation also makes your debt more expensive because that means now you have to pay back your debt with more valuable dollars. And so now if the United States government is sitting on $35 trillion worth of debt and then you start to see deflation, that means that debt starts to become a whole lot more expensive versus if you have inflation, now that debt starts to become less valuable and that means now you can pay back all this debt with less valuable dollars. That's why the government wants inflation. That's why the central bank wants inflation, because they want the value of the dollar to go down. And the problem that I have with this is that the majority of us, myself included, didn't grow up with any sort of financial education. We're told to go to school, get a job, work, make money, spend money, but we're never told how our economic system works. But the reality is, if you don't understand how the system works, you end up getting screwed by the system, because who does inflation hurt? Inflation hurts consumers. And every single person in America is the consumer. I don't care if you're rich. I don't care if you're poor. I don't care if you're middle class. Everybody's a consumer because everybody's got to eat. Everybody needs clothes. Everybody buys cars. Everybody needs things. Because everybody's a consumer. And inflation means that you need more dollars to consume. But inflation disproportionately benefits the financially educated. What does that mean? When you have inflation, asset prices rise. That's why Wall Street loves inflation. The stock market has rallied over the last 5 years. Over the last 5 years, we have seen wages in America grow by around 20 to 25%, median incomes, while the prices of things have risen more than that. While the S&P 500, the stock market has grown by more than 80% minus the last few days worth of crashes. So we saw the stock market rally significantly faster than incomes, which means the rich got richer, the financially educated got richer, while the average person got poorer. How did they get poorer? Because your salary doesn't stretch as far. Even if you got a raise, for the average person, your raise did not keep up with inflation, which means, sure, you made more money, but more of your paycheck is going to pay off your mortgage. More of your paycheck is going to pay off your rent. More of your paycheck is going to your car. More of your paycheck is going to your groceries, which means you have less money to save, less money to invest, even though you're making more money. And the majority of people don't understand how that works. And the reason why is because most people don't understand how inflation affects them. Inflation disproportionately hurts the financially uneducated. So now we have the Federal Reserve Bank talking about how they would fix this issue if market conditions start to deteriorate. Well, what we've been seeing happen is just the markets fall a little bit. Now, I'm going to be completely honest with you. You can take this for whatever it's worth. I don't make these videos to make friends. I make these videos to help you be better with money. And I get it. People don't like what I say, but I'm going to tell you this anyways. The reality is, over the last week, this market crash, if you want to call it, that we've been seeing, really hasn't been that much yet. I mean, yeah, the NASDAQ has entered correction territory, but just take a look at how much markets have run up over the last 5 years. Yeah, we saw a little bit of a correction, but we're nowhere near anything drastic. I mean, when the 2000 dot-com bubble burst, the NASDAQ fell by like 90%. When real estate prices crashed in 2008, don't forget that housing market prices across the country fell by at least 30%. In Michigan, they fell by 80 to 90%. When the 2020 pandemic hit, the stock market fell by more than 30% in just a few days. So yes, we have seen markets fall, but we have seen markets fall even faster before. So I want you to understand that, and you want to understand what's kind of going on in the grand scheme of things. Obviously, people have been panicking because nobody wants to see their portfolios fall, but I want to answer this question, what does it mean of the Federal Reserve Bank fixing it? If the Federal Reserve Bank tries to fix it, well, that means that they would want to create more money. They can create more money by doing either quantitative easing or by cutting interest rates. Quantitative easing is when they start printing money. Now, what do they do with this money that they print? They can take this money and lend it to the government. They can take this money and inject it into the markets by buying treasury bonds. Or they could take this money and do something different. What do I mean by that? Well, when the 2020 pandemic hit, the Federal Reserve Bank created an emergency program to lend money to corporations by purchasing corporate bond funds, meaning they were lending this money to corporations by buying a whole bunch of these bonds. So there are ways for the Federal Reserve Bank to manipulate the markets. And you don't want to fight the Federal Reserve Bank. I just want you to understand how this works, because the Federal Reserve Bank likes to see markets booming, especially during an election year. But let's talk about that now. What is the implication of the Federal Reserve Bank potentially doing quantitative easing? What is the implication of the Federal Reserve Bank potentially cutting interest rates? Well, inflation is still around. I mean, the prices of things are still rising. The average person is struggling to buy things. The average person in America now has more debt than ever before. Credit card debt in America has broken a new record high. Household debt in America has broken a new record high. The average new car payment is at the highest number we've ever seen before. The average used car payment in America is like $523 now a month. That used to be what a new car payment used to cost. But we have all these things happening. Now, if we start to cut interest rates early, a lot of people would say, hey, it's going to save the economy, it's going to stimulate the economy, it'll save the stock market. But there are consequences to that as well, because you have a lot of people that still have money. You have a lot of people that are sitting on the sidelines that are waiting to buy a home. You have a lot of people that want to buy a car. You have a lot of people that want to spend, because, yeah, we have a lot of people that are broke, but you still have money out there. And if the Federal Reserve Bank starts to cut interest rates, well, that can push more buyers into these things, which can push the prices of these things up. Because if mortgage rates were to fall to 4% tomorrow, what do you think is going to happen? Everybody and their moms and their cousins and their sisters and your friends are going to want to go out and buy a home again too. You would see more bidding wars on homes. We've already seen mortgage rates start to fall because people are anticipating the Federal Reserve Bank cutting interest rates. But if more and more people start to buy homes, that could create more of an inflation problem. Again, we haven't fought or fixed the inflation problem fully. And if you start to inflate or stimulate economy without fixing the inflation problem, you can make the inflation problem worse. So now the question is, what's more important? Is it the economy or is it inflation? This has been something that we've been talking about for about 2 years now. All of 2023, I was talking about how 2023 is not the year to go out and finance a new truck, because that was the time to start getting financially smart, save that money, that way you can find opportunities. But this is where I want you to understand, if the Federal Reserve Bank starts saving it, yeah, you could boost the markets. It will be great for my portfolio. It will be great for the financially educated. But then that can make the inflation problem, the long-term inflation problem, worse. Because, well, inflation happens when you create more money. Inflation comes from the word inflate. What are you inflating when you have inflation? You are inflating the monetary supply. So now that we understand what it means for the Federal Reserve Bank to potentially try to fix it, and we'll see what they actually do. We'll be keeping you covered here and on Market Briefs, such as my free financial newsletter. The third thing is, what does this mean for you and how do you build wealth? And let me start with the very basics. Do not panic. Now listen, I am just a random guy on YouTube. I'm not a financial advisor. I can't tell you what to do. I don't recommend what I do to anybody else. You got to do your own due diligence. Investing has risks. You're going to lose money at some time. Okay, got the disclaimer out. Now, what else you got to understand? Markets go up, markets go down. That's a fact. We know that recessions happen. We know that market crashes happen. We have seen a recession every decade in the United States for the last century. The longest period that we've gone without a recession was after the 2008 crash and before the 2020 pandemic. Now, that being said, recessions also create more millionaires than any other time. The reason why is because they create great buying opportunities for those that are financially educated, for those that are financially savvy. What does that mean? When the 2020 pandemic hit, the investors that were buying stocks were able to buy stocks at huge discounts and make a lot of money very quickly because the Federal Reserve Bank then bailed out the stock market. I've been working in the financial space for a long time. I own a financial media company. Briefs Media is a financial media company. I have studied a lot of financial history. I had no idea that the Federal Reserve Bank, I could have never predicted that the Federal Reserve Bank was going to stimulate the stock market at the rate that they did in 2020. But let's back up a little bit even more. When the 2008 crash happened, the investors that were buying real estate after that crash, when everybody was running away, were able to buy real estate at huge discounts. And if you held on and bought good investments, you're able to see big returns. Same thing happened during the 2000 dot-com bubble bursting. So what I want you to understand now when it comes to these types of situations is there's going to be a lot of emotion. The traditional media loves to sell emotion. They're going to tell you either the world is ending or that there's so much money to be made. But if you're getting caught up in the emotion, well, you're the person that's making somebody else rich. What you want to do is understand that emotions are the enemy of profit. So now, if you want to be able to build wealth when you see these things happen in the economy, the first thing you got to do is stay calm. and not be driven by emotion. The second thing you want to do is look at what investments do you own. Do you own strong investments, or do you own something on the verge of bankruptcy? And just because the price of an asset is falling doesn't necessarily mean it's going into bankruptcy. You have to look at the underlying asset itself. Look at the fundamentals, look at the earnings, look at the financials, look at the balance sheet, look at the cash flow statement. If you don't know how to do all that, then maybe you shouldn't be investing in individual companies. Then maybe you want to consider investing in index funds or ETFs or mutual funds. Like there are funds that can give you exposure to the total stock market. There are funds that can give you exposure to the S&P 500, the group of the 500 largest companies in the stock market. There are funds that can give you exposure to the NASDAQ, to the Dow Jones, to healthcare companies, to tech companies. The list goes on and on. And if you're investing in these funds, well, now you're just investing in the market. And if markets go down, it creates a good buying opportunity because then you can buy more of that thing on sale. The interesting thing about the stock market, it's the only place that when the item goes on sale, people run away. When Macy's goes on sale, people line up. When the stock market goes on sale, people run away. And this is where now you got to understand your strategy. You want to stay calm and stick with your strategy. And there are two different ways that you can play the stock market. You have a passive investing strategy and an active investing strategy. Passive investing is what many people call dollar cost averaging, where you're investing your money into the markets, whether it's your 401k, whether it's your own investments, you're investing every week, every 2 weeks, every month. You're just buying some funds and it's on autopilot. You don't change that. In fact, the only thing that you would change is you potentially increase how much money that you're investing, because when markets go down, markets go on sale, and now you can go out and buy more because you are a long-term investor. The whole idea of investing for the long term is you're a long-term investor, that you know that economic crashes that happen. You know the market crashes are going to happen, and those are times you just got to be able to withstand and buy more of. That way you can continue to build more wealth. The problem that people have with this is they look at their stock market account or their 401k like their checkers account. If things go down, they panic and they sell because they want to be able to buy an Xbox. That's not the way to look at your investments. Remember, I'm not a trader. Trading is a job. It is a form of gambling. That's not what I do. I know every time I say that, people are going to get very angry, but I don't know how to trade, okay? I'm talking about investing. When we talk about long-term investing, it's a very different game. Where now you're investing in the underlying asset and you want to hold on to it for the long term. And if you want to hold on to it for the long term, who cares what's happening in the day-to-day? Ignore the news, pay attention to the trends. Watch the financial trends, study the financial trends, see what industries are growing, see what industries are seeing opportunities, because yes, there are industries that are growing right now. The alternative is an active investing style. And active investing is now where you're investing in individual companies. Now, what I like to say is that this type of active investing should only be done by 2% of people. 98% of people should be doing passive investing because most people don't have the time, they don't have the interest, and they don't have the education, and they don't have the psychology to do active investing. Because if you're investing in individual companies, you need to know what it is that you're investing in. If you're buying the Amazon stock, you should understand what's happening with the earnings calls. What does their balance sheet look like? What does their cash flow statement look like? What does their income sheet look like? And if you don't understand the income statement, well, then maybe you shouldn't be investing in that company because you're just investing in whatever you think is cool. Which, yes, it can make you a lot of money, but if Amazon goes bankrupt, you lose everything. And you want to be able to understand that, especially if it's your life savings that are involved. And so you want to know what it is that you are investing in and know your strategy. Now, once you know your strategy, you just want to find the right opportunity. Like when you're passive investing, if you're just investing your money every week or every 2 weeks or every month, you just stick with your strategy. You don't panic. You stick with your strategy and you keep investing. Maybe you invest a little bit more. If you're active investing and you want to invest in individual companies, which you should be doing, build a list of companies that you want to invest in. Do that research beforehand. You don't do the research when everybody's panicking. That's the worst time to do research. Do research when you're in a calm and level mind. Make a list of companies that you want to own and understand why. Then do your analysis to find what is a good buy price for you to come in and purchase. Then if you see the stock hit the price, you can come in and start buying. If the company falls even lower, you can buy even more. If it falls even lower, you can buy even more. I call this drip investing, where I buy in phases on the way down. Now, I personally, and again, I can't tell you what to do. I'm just telling you what I do. I do a passive investing style, and I also do an active investing style. So when you see these market pullbacks, the last thing that you want to do is panic. In fact, don't even put it on the list. Panicking does not do anything. The media loves selling emotion, okay? Don't get caught up in that emotional game. Understand what's happening, cut through the noise, and find the opportunity. Now, the reason why I don't give stock picks is because what's right for me may or may not be right for you. My risk tolerance is different than yours, and my goals are different than yours. For example, when I invest passively, the bulk of my passive investments are for cash flow, meaning dividend paying funds. So the way that I look at it is I just want to work to stack the dividend, stack the cash flow. Every week, I do it on Wednesdays. Why Wednesdays? Because it's in the middle of the week. I don't have any secret science as to why I buy on Wednesdays. It's just what I do. Every week, money leaves my checkings account and is automatically invested into my portfolio of funds. And that happens whether the market's up, whether the market's down, whether it's raining, whether it's sunny, whatever's happening, I'm doing that no matter what. On the active investing side, I'm working to put more money into a bank account that has cash waiting to be invested, or I'm looking for the right financial trends and the right companies that way I can find a company at a good price and then come in and buy. There's two ways to find a good price. One way is you see a market crash because that affects pretty much the entire stock market. The other way is you look for an industry-specific opportunity where you see a company that you believe is trading at a good price. Now again, there's a lot of ways to study your financial education, your trends, and be prepared. The way that you can study financial trends is number one, look at consumer behavior. Look at things that are happening in the economy. Look at things that are happening around you. See what is changing and see different regulations that are happening in a government as well. I'll be going over a lot of this on my Investor Summit on how you can find these financial trends and find one that's right for you. If you'd like to join me, again, I got the link for you down in the description. But that's all about now understanding how money is moving because you want to be investing in an industry where the money is going into. Your financial education is how do you analyze your investment? If you're investing in an index fund, how do you know what's a good index fund? If you're investing in the S&P 500, which fund do you actually purchase? How do you analyze the expense ratio? I have videos on my channel where I go over this. We'll also be going over this on my Investor Summit, but just invest some time in it. You can read books on this. You can take classes on this. You can watch YouTube videos on this. There's so many resources. Even if you don't want to watch mine, go watch somebody else's, but invest in your financial education. Then being prepared is all about having that cash put aside. That means having cash put aside to protect you against an emergency, say in case you get laid off, in case something happens to your company, in case something happens to your business. Being prepared is having that cash to protect you, but being prepared also means having cash to be able to capitalize on opportunities because the reality is you could have all the financial education in the world. You see the next hot financial trend. You see an amazing economic opportunity. You see an amazing investment opportunity. You see a great buy point, but you don't have any money to invest. Well, that doesn't do you any good. Now, the best time to prepare, obviously, is not when you're in a tough financial situation. The best time to prepare is when times are okay. But this is where my goal for you is to be a financially educated investor, not get caught up in the panic, not get caught up in the fear, not get caught up in the emotion. Tomorrow, I'm going to be going over this in even deeper depth. So make sure you watch that video tomorrow. I just got back from Manhattan, so I'm starting to get back into the swing of things and making videos. But watch that video tomorrow because that's going to explain that way more. But I want you to be a financially savvy investor. That way you can find the opportunities while the majority of people are losing. Because every time you see a downturn, no matter how many times I can make videos talking about this, it's going to be the same thing. People will panic, people will freak out, people won't know what's going on, and then they're going to lose money. But I want you to be one of the people that can cut through the noise and remember that you're a long-term investor. I mean, it's the same thing with cryptocurrency. Just look at what's been happening with Bitcoin prices. Bitcoin prices fell by like more than 10% in just 24 hours. People have been worried about that. That creates a sell-off. And then the interesting thing about some of these assets is as prices start to go down, that creates more panic, especially when people are trading on margin, because you have a lot of people that are buying Bitcoin and stocks on margin, meaning with debt leverage. And so when you see the asset value go down and you're buying this asset with debt, now you start to panic even more because you're underwater on your investment, especially if stock prices or asset prices fall very quickly. And that can create you to panic. That can also create forced sales, which are called margin calls. A margin call is when a stock brokerage that lent you money forces you to sell because you invested into something, that thing fell in value, and now because you're underwater, the stock brokerage wants to protect their investment, which is the loan that they gave you, and they're going to force you to sell out of that investment. That's called a margin call. And anytime you see asset prices fall quickly, you then start to see an even more drop because people panic, they oversell, and then you see margin calls happen, which then forces it to go down even more, but that creates opportunity. You've probably heard me talk about poop before. When I say poop, I mean panic leads to overselling, leads to opportunity, leads to profit, but the only people that can take advantage of poop are the people that really understand what poop is, because the majority of people don't understand poop, and secondly, the people that are financially calm and savvy to be able to take advantage of opportunities, because a lot of people just don't have the psychology to be able to take advantage of opportunities when they come your way. So I want you to stay calm, understand what's happening. Don't be one of the people that freaks out. I get it. There's a lot of things happening on the internet. It can make it a lot easier to freak out. Stay calm, look for the opportunity, and remember, if you're a long-term investor, you're a long-term investor. Don't switch to a trader just because something bad happened over the course of a week, a month, or even a year.